Good morning and welcome to Business Buzz. Coming up, an expert on Nigeria's public policy and policy analyst joins us live as manufacturers warn the sector is under its heaviest strain in years. The Nigerian exchange closed 1% higher, adding more than 1.5 trillion naira in value. Oil prices surged past $90 a barrel as the crisis in the Strait of Hormuz deepens. At home, a pricing standoff at the Dangote refinery raises fresh fears over the cost of petrol. And Nigeria's central bank signals interest rates will stay high as its rate-setting committee began meeting yesterday. I am Louisa Asidi. Stay with us. Welcome back. We begin this morning with Nigeria's factories and mounting signs of strain across the manufacturing sector. Company income tax paid by manufacturers fell by more than 2/3 in the first quarter of the year. Part of that reflects a lower tax rate, but manufacturers point to a harder story underneath, and the cost of power, the cost of borrowing, and the cost of foreign exchange. The 1 trillion naira stabilization fund promised in 2024 has still not reached them. To take us through what is happening on the factory floor, I am joined by Ayo Ologun, a public policy and analyst who is here with us today. Good morning, sir. You're welcome to the show.
Thank you for having me.
Okay, we have a question, first of all. When you look at the manufacturing sector right now in Nigeria, do you think it is shrinking, surviving, or just standing still?
Well, thank you very much. The manufacturing industry in Nigeria is definitely not standing up still. It's definitely not shrinking. But I can tell you that based on the facts available, it's definitely not making progress as expected. There's a difference between when you make progress and when you make movement. What's happening within the manufacturing tech sector is more of a movement than progress. And that's because as much as support from the federal government has been touted, it has not really had an effect that is measurable on the manufacturing industry or the manufacturing sector of the country. And until when manufacturers can boldly beat their chest to say that their cost of production compared to the consumption of their product is synonymous to such that brings profit, then no one can confidently say that progress is being made. As it is in the country now, the amount of money being used as overhead, the amount of money being used as recurrent expenditure for all of these manufacturing companies compared to the measure and the rate at which their products are being consumed is not at par. Because a lot of people go for much more of imported goods for those who can afford it. For those who could not afford it, they go for second-hand products, which you call Okrika and the rest of them. And this cuts across, not just the clothing industry, it cuts across furniture, it cuts across different areas of manufacturing. So until when the cost of production can stabilize to the level of consumption, which can bring profit, then we cannot say the manufacturing industry of the country is making substantial progress.
Okay, so what would you say is causing the most damage to Nigerian manufacturing today? Is it power, borrowing, foreign exchange, or logistics?
A lot of things are responsible. Majorly, let me list three for the record. Number one of the major problems that manufacturers are facing in the country is the cost of foreign exchange, what you call forex. most of these manufacturers have to import their raw materials. And when you look at the exchange rates, either to dollar or to euro or to yuan, as the case may be, if you look at the exchange rate of naira to all of this currency, by the time they import the raw materials needed for production, it's already skyrocketing. The cost by the time it is produced, because the rate at which they buy is not synonymous or is not in tandem with the rate at which their own currency is being used for exchange. That's number one. Number two is the tax regime. A lot of time, if you look at it back in the days of Obasanjo and substantially that of the Jonathan regime, one of the things that gave manufacturers a lead or that gave them a relief was the fact that there were a lot of waivers during those two regimes, the Obasanjo regime and the Jonathan regime. There were a lot of waivers. There were waivers for those who were importing iron. There were waivers for those who were importing one product or the other, or one raw material or the other. And in the moment the new administration came in, particularly in the days of Muhammadu Buhari, those waivers ceased. And that means that for everything, for every raw material imported, for every product imported in the country, manufacturers have to pay. They have to pay import tax. They have to pay the seaport tax. They have to pay the cost of transportation from the seaport to wherever their location or their company is located. So when you put all of this together, the tax regime is also killing the manufacturing industry in this country. And the third aspect of it is that Nigerians are not comfortable with the quality of product most of the time. And you don't blame manufacturers. When they produce products at the highest quality rate that you can imagine, the cost becomes unbearable or unattainable for an average Nigerian. So in order to have more market, in order to have more sales, they lower the quality of their product. And then a particular segment of the country also begins to feel those products or those materials are too cheap for their status. And even the ordinary Nigerians who they are producing for cannot even afford to buy. So most of the time, products are made, stored up in different stores and what have you, and it does not even get to the market. And those that get to the market does not even get bought because the people does not have the economic power to buy the products at the rate at which the cost of production can allow. So what you see is that an average Nigerian goes for second-hand used products just to make up. So at that rate, you are killing manufacturers because they are investing their fund into the production, and yet, even though they are meeting up with the market demand, people cannot afford to get the product at the rate at which they will be willing to sell. So these three issues are things that kill the manufacturing industry at a very fast pace in the country.
Okay, manufacturers generate much of their own electricity. Now, do you think that would actually affect the price of what they make? And if their products can compete with these imported goods, do you think they can compete?
Yes, they definitely can compete. I've had to argue this a number of times. An average manufacturing company in Nigeria can produce exactly the quality of material that have been imported. Sometimes they can even produce better quality. But the question is, at the end of the production, by the time they measure the cost, it becomes unbearable for the market. Because those who are manufacturing from outside of the country, at the quality at which they are manufacturing, their products are being manufactured in tons, in thousands, in millions, in billions. So by the time they had importation rates to it, it still does not meet up with the cost of production in Nigeria. So the question is not about Nigerian companies not being able to produce quality material. Then the question is, would the consumers be able to afford the cost at which they will sell by the time they produce at the quality the Nigerians are expecting? And just like you rightly mentioned, how do you blame a manufacturer who is the one responsible for his own power supply? Substantially, despite the investment into the electricity sector, most cities, most villages, and most states in Nigeria are not even having constant access to electricity. So a manufacturer who needs to produce products at a particular measure of each will not want to depend on power supply of the federal government that can go over at any time and they stop production. So they would rather shift on producing their own energy supply, which means they have to depend on solar most times. Some has to depend on generator. So by the time you look at the costs of fueling generator, particularly by diesel, and then you have that to the cost of production, plus the cost of importation of raw materials at the exchange rate that has become messed up What you have is when they produce at the quality expected, the market cannot afford to pay for it. So what manufacturers do is to go for production at a very affordable rate, which makes the quality less acceptable.
Okay, that's good. Now, the government announced a 1 trillion naira stabilization fund for manufacturers back in 2024. 2 years on, it hasn't been released. Now, do you think this fund, first of all, would it actually even help? And also, if the underlying problems aren't fixed, is handing out cheap loans safe, or does it just load struggling firms with more debts?
See, there are many indices to the questions you've just asked. Number one, the problem with us as Nigerians is that when we have figures, we get carried away by big figures. When do anybody hears the amount 1 trillion, what is likely going to come to mind is, oh, that's a lot of money. But between you and I, for companies that produce some specific kind of product, 1 trillion naira is nothing. For example, you are giving loan to Dangote Refinery and you're offering him a loan, 1 trillion. You probably not done so much because by the time that is breaking down into the different segments or the different investment of Dangote Refineries, you discover that that money is nothing. Not to now talk of when you now break 1 trillion naira down to about 200, 300 major manufacturers. The question is, what amount of money will get to each of these manufacturing companies by the time it is broken down? Of course, if the federal government is issuing 1 trillion naira bond support for our manufacturers, maybe we're having about 200 or 300 companies or production companies that will apply. By the time it is broken down, the maximum each one will get is about 20 to 25 million. 20 to 25 million cannot even buy some machines that are used in production. That's number one. So if you do not address the underlying factor which will enhance production. What are the underlying factors? One of it is what we have mentioned, electricity. If the problem of electricity is not fixed, and they still have to be depending on diesel to power machines which they are using to produce, and then the roads are not fixed, even when they are bringing raw materials or they are bringing personnel to the factory, the vehicles have to break down, they have to incur expenses on fixing their trailers and their trucks and what have you. And even after production, the roads are not fixed. They have to encounter a lot of problem in moving products from the company to the market. You know, along the way, some of their trucks, some of their trailers breaks down. It doesn't get fixed in 3-4 days. The market is expecting it. The product is not getting to the market. They are making losses. So if all of these underlying factors are not fixed, it does not matter how much trillion or how many trillions of naira is injected into the economy through the manufacturing company. It will hold no water because as much as they get as loan or grant as the case may be, get sunk into the same problem that has not been fixed, that is making production, the quality of production, and the cost of production to be as high as it is.
Okay, looking at the manufacturing sector, it's not all decline. Cement, food, and beverages, they have all been produced by the Dangote refinery. Now, what do you think the Dangote refinery got right that the textile mills and other refineries didn't get?
Two things. Number one is funding. You will recall that one of the things that made it easier for Dangote refinery to get this far is the fact that number one, the federal government bought into that investment. The local investment in Ondo State, which Dangote owns, and the one at the Lekki axis of Lagos State. The Lagos State has investment in it. The land was an investment of Lagos State. The federal government injected about 25% into that company. How many company or how many manufacturing company in Nigeria enjoy such grace? That's number one. Number two, Dangote Refinery, for example, enjoys the monopoly, which is granted by the federal government, whereby they have the first line of charge or the first right of refuse when raw materials are being processed, that is crude oil. Dangote Refinery is on the first line of charge in crude oil supply before even exports to the country. The third one, Dangote also has the benefit of buying by Naira, which many other companies do not have. So Dangote as a company is enjoying a lot of bypasses, is enjoying a lot of waivers, which many other companies are not enjoying. So it's not as if it's only Dangote Refinery can get it right, but the waivers and the benefit that Dangote Refinery or the Dangote company is getting from the federal government, how many of such companies like his are having that advantage? That's number one. Number two, how many companies or manufacturing companies that have even human capacity, like Dangote Refinery is having, how many of them are having access to loan or having access to resources by which to push up their production to meet up with the needs of the people? So it's not as if Dangote is monopolizing the whole thing. It's because privileges that Dangote Refinery or Dangote company is enjoying, many other manufacturers in Nigeria are not enjoying it.
Okay. Now, if you look at 12 months ahead, do you see more factories closing or do you see a start of a turnaround? And what's the one signal that will tell us which way the manufacturing sector is going?
See, one of the problems we've had that brought us to this point is the fact that at a point in the history of this country, we depended on international manufacturing companies to come to Nigeria to invest and to produce. And when production and the cost of production became unbearable for many of them, they left the country. You talk about Dunlop, you talk about PZ, you talk about many other companies who are practically producing for us in Nigeria, and they are not Nigerian-owned companies. So when they felt uncomfortable, when they felt that they do not have what is needed any longer, what they simply do is to move their businesses to other neighboring countries where they can enjoy waivers of the government and stable electricity consumption. So I am of this opinion, and this has been my agitation over time, that we need to have more indigenous companies in the countries. Only when we begin to develop or invest in more indigenous companies that we can have stability in production. We can produce what we are consuming. But if we have to be depending on other nations of the world, other investors or other companies from outside the country to come and be opening manufacturing company here, for as long as we keep encountering problems, they will keep living. Maybe after some years, one or two will return. They will encounter another problem, they will leave. But if you are a Nigerian investing in Nigeria, you are a manufacturer in Nigeria, and you know for sure that whatever you need as waivers or as help from the country you are getting from your government, and you know that there is no way you are living for, then there will be more concentration, there will be more dedication, there will be more commitment to local manufacturers doing the best that they need to do to ensure that we produce what we consume. But for as long as we are competing or we are depending on international manufacturing companies to come and be domiciled in Nigeria to produce what we consume, we are not going to have a network. Number two, you talked about what is obtainable, what is seeable in the next 12 months. The federal government needs to be decisive. It's not just enough to issue loans, bonds, or whatever money you are giving to help or to rejuvenate an industry. It's not enough. There are underlying factors that need to be fixed. If Nigerian government is deliberate in ensuring that manufacturing companies in Nigeria are going to succeed, number one, the issue of electricity needs to be permanently fixed. No manufacturing company can succeed without power. And if you have to be depending on the production of your own power to be able to produce products, you are already changing yourself because the money you've been invested in power generation could have been used to do other things in the manufacturing chain. So if the federal government is deliberate in enhancing and rejuvenating the production of the manufacturing company of this country, number one, the government needs to do well and fast in ensuring that the problem of power, particularly electricity, is fixed. Number two is road access. If you look at the Lagos Ogun axis, that is where you have majority of manufacturing companies in Nigeria today, domiciled. But many of them do not even have access roads. Look at the road linking Shagamu to Ikorodu. Look at the road linking Abeokuta to the Lagos Expressway, where we have majority of this. So for as long as how many companies can afford to make roads where their trailers and their trucks will pass on? These are the duty of the government. So if the government is deliberate or going to be deliberate in ensuring that the manufacturing companies or the manufacturing sector of this country is regulated, the federal government needs to be deliberate in fixing our roads so that there can be access between the manufacturer and the market. Not when the market is expecting products and the trucks and the trailers bringing products is stocked on one bad road in Ibisa, in Ogun State, or in some other parts of the country where access are not made. So it's a win-win thing. If the federal government is going to show being deliberate, there need to be deliberate actions in fixing the underlying factors and problems. It is only then that we can hope that in another 12 months, that is a year, we can have more companies springing up. And those who are already established and they are bringing products can be encouraged to do more to meet the market need.
Okay, thank you, Mr. Ayo Logun, manufacturing industry veteran, for your time. Thank you so much. We'll be
Thank
back
you very,
right now.
thank you very
Stay
much,
with
ma'am.
us. We begin with the markets, where the Nigerian exchange advanced on Monday. The all share index added 2,431 points, a gain of 1%, to close at 245,893.5. Meanwhile, market capitalization rose by 1.57 trillion naira to 158.63 trillion naira. BUA Cement led the gainers up just under 10% to 303 naira 10 kobo, followed closely by First Holding Company and FTN Cocoa. Sinu Assurance paced the losers down 10% to 3 naira 60 kobo. Now to the story moving every market this morning. Crude oil climbed above $90 a barrel as military conflicts between the United States and Iran disrupted shipping through the Strait of Hormuz. Brent rose almost 3% to $90.70, while West Texas Intermediate gained to just under $85, with both benchmarks at their highest levels in more than a month. The strait, which carries roughly one-fifth of the world's oil and tanker traffic, has now fallen to its lowest in 2 months, with some vessels switching off their tracking systems for safety. For Nigeria, higher crude means stronger export earnings, but also more expensive imported fuel and increased pressure on prices at home. Now to energy, where a pricing dispute at home is unsettling the fuel market. Petroleum makers say large-scale loading has slowed at the Dangote refinery after the plant moved to price its fuel in United States dollar, with Dangote denying halting loading and calling the reports false. At the heart of the role is crude supply and competition. The refinery is unhappy that the government continues to issue import licenses to marketers and that too little of the crude it needs is being sold to it in naira, forcing most purchases in dollar. However, the Independent Petroleum Marketers Association is opposing these import licenses, warning they are worsening price volatility and putting pressure on the naira, which has weakened to 1,400 to the dollar. The landing cost of imported petrol at about 1,350 naira a litre is running roughly 20% above Dangote's price. Meanwhile, the consumer regulator insists the naira remains the only lawful currency for domestic sales, and the federal government says it will not allow any single player to hold the country to ransom. For the Nigerian motorist, it all points one way. There is still a continued uncertainty over the pump price, even as global crude eases. Marketers for now say there is no scarcity and are urging against panic buying. We'll go on a break right now, and when we return, more Business Buzz. Welcome back. Now to monetary policy, where the Central Bank of Nigeria has signaled there will be no rate cut anytime soon. The monetary policy began meeting yesterday with Governor Olayemi Cardoso saying the prolonged conflict in the Middle East has dimmed hopes of an easing circle despite 11 straight months of disinflation. Headline inflation eased slightly to 15.9% in June, but analysts say they expect the committee to hold the benchmark rate at 26.5%, citing renewed pressure on the naira and elevated energy prices. For households and businesses, that means borrowing costs will continue to stay high for long due to the price of protecting the currency and keeping imported inflation at bay. Moving on to the economy, where the federal government is set to issue a second bond worth about 729 billion naira to settle verified debts owed to electricity generation companies. The issuance follows a 501 billion naira bond released in January, bringing the first phase of the presidential power sector debt reduction program to roughly 1.3 trillion naira, which is part of a broader 4 trillion naira plan. The Nigerian Bulk Electricity Trading Company says the first bond's coupon and principal were paid promptly and in full this month, a signal to investors ahead of today's Investors Forum. If it works, the program could restore liquidity across the power value chain, and that matters to every Nigerian home and factory waiting on reliable supply. In fiscal news, state governments received 2.37 trillion naira from value-added tax in the first half of this year, up almost a quarter on the same period last year. This jump reflects the new tax regime that took effect in January, which raised the state's share of value-added tax from 50% to 55%, while cutting the federal government's portion to 10%. Due to this formula change, the state had an extra 215 billion naira in 6 months. However, the question analysts are asking now is quite simple. Would that money be spent, or will it be invested? It's time now for a second break. When we return, we'll look at what's happening for big business owners. Welcome back. Now to a deadline for big business. The Nigeria Revenue Service has directed all large taxpayers, companies with annual turnover of 5 billion naira and above, to fully adopt the national e-invoicing system by the 31st of July. More than 1,000 companies have already complied, but the service warns defaulters risk regulatory and enforcement action as the system transmits transaction data to the tax authority in real time, tightening the net on leakages. In the banking sector, new capital rules proposed by the central bank could force Nigeria's leading banking groups to raise a combined 972 billion naira in fresh equity, according to Resonance Capital Africa. Access Holdings would carry the largest burden, around 656 billion naira, or nearly 70% of the projected shortfall, with First Holding Company, FCMB, Guarantee Trust, and Stanbic IBTC, which are also affected. If the rules become actualized in its current form, the framework could trigger a fresh wave of capital raising on the Nigerian exchange, even as the country's top banks continue to outpace their South African peers in assets growth. Now to some brighter news for the Nigerian tech sector. Nigerian startups attracted $254 million in the first half of this year, the first time the country has crossed the $250 million mark since 2022. Nigeria was also Africa's largest market for equity investment, ahead of Egypt, even as Kenya and South Africa recorded sharp declines. Analysts caution, however, that capital is concentrating in larger, mature companies, leaving early-stage founders still struggling for seed funding. Staying with investments, the battery rental company MOPO, backed by Britain's Octopus Energy, has signed a $75 million agreement with the Rural Electrification Agency. The deal will see households and small businesses rent rechargeable batteries rather than buying costly solar systems, starting with a pilot this year and expanding nationwide by 2030. This is a fresh approach to one of Nigeria's oldest problems, and it is an affordable and a reliable power for communities beyond the grid. Let's take one more break. More business news still ahead. Welcome back. Now to regional energy and a major step for the $25 billion Nigeria-Morocco gas pipeline. ECOWAS member states have signed an intergovernmental agreement backing the project at a ceremony in Freetown, Sierra Leone. The pipeline is designed to carry up to 30 billion cubic meters of gas a year from Nigeria through 13 West African countries to Morocco and on to Europe along a route of almost 7,000 kilometers. With feasibility and engineering design phases complete, attention now turns to financing one of Africa's most ambitious infrastructure projects. Elsewhere in the West African region, Ghana has opened bidding for new 5G spectrum licensing after revoking an exclusive infrastructure deal backed by Indian billionaire Mukesh Ambani. Licenses will run for 15 years, with minimum prices ranging from $10 million to $36 million, and market leader MTN facing a 40% premium on its bid because of its dominance. Applications will close on the 6th of August, with winners announced before the end of that month. This is a reset Accra hopes will spur competition in ultra-fast broadband. And finally, to Angola, which is presenting itself as an economy moving beyond oil. Inflation there has eased to just above 10%, the lowest in more than a decade, and the government projects non-oil revenue will exceed oil revenue for the first time on record. Angola has also overtaken Kenya to become Africa's 6th largest economy, though much of that jump was powered by the very oil wildfall from the Hormuz crisis. However, the International Monetary Fund warns oil revenues remain in structural decline, meaning that what the diversification Luanda is selling will soon be put to tests. This is all we have for you today on Business Buzz. I am Louisa Asidi. Thank you for watching.